You know, usually when we try to take the economic temperature of a sprawling city, we instinctively look up.
Right, yeah. You look at the skyline.
Exactly. Look at the skyline. We look for, the shiny glass office towers, the construction cranes hovering over downtown, the corporate logos illuminated on the top floors.
Oh, totally. It's just, I mean, it is the natural human instinct to look at what is prominent and glittering right in front of us.
Right.
And we just kind of assume that is where the real money is moving.
We do. But what if the real heartbeat of a regional economy isn't up in the sky at all?
Hmm.
What if it is hidden down at the water's edge? And frankly, in millions of square feet of just featureless gray concrete boxes sprawling out into the suburbs.
Which is not nearly as glamorous.
No, not at all. But that's what we're looking at today. We're taking you on a journey today to uncover the hidden mechanics of global trade. We're doing a deep dive into the Q2 2026 Port Houston Market Report by Lee and Associates.
And it is a fascinating read.
It really is. The goal here is for you to figure out how a single geographic feature like a waterway can completely dictate the physical footprint of an entire region.
Yeah, it literally reshapes the map.
Exactly. And I want to kick things off with a paradox that jumped out of this data for me. How does a port handle over 4 million shipping containers a year, breaking all-time records, while at the exact same time, the local warehouse market is sitting on an 11.3% vacancy rate?
It sounds totally backwards, right?
Right. Why is all that empty space actually a sign of calculated, staggering optimism?
Well, that contradiction perfectly illustrates the delay between physical cargo arriving on a ship and, the real estate required to absorb it.
Yeah.
To understand the empty buildings, you basically have to understand the water.
Okay, so let's start at the water, because before we can even talk about the real estate on land, the warehouses, the trucks, the concrete,
Yeah.
we really have to understand the sheer scale of the engine driving all of this.
Yeah.
And that engine is the Houston Ship Channel. I mean, this isn't just a river. It is a 52-mile waterway that acts as the cardiovascular system for the entire region. It is the main artery.
Yeah, and the volume of traffic flowing through that artery is, well, it's difficult to overstate.
How big are we talking?
So the report notes that the Houston Ship Channel is the busiest waterway in the United States by tonnage
Wait, the busiest in the whole U.S.?
in the whole country. Yeah. Just looking back a bit to set the baseline, in 2023, it handled 309.5 million short tons of cargo.
Wow.
Yeah. To put that in perspective for you,
Hmm.
that represents about 12% of all U.S. waterborne trade moving through this 152-mile stretch of water.
12% of the entire country's waterborne trade going through one single channel. That is wild.
It really is.
And the data shows Port Houston shattered records recently. They handled 4.14 million TEUs in 2024, and then they broke that record again, climbing to 4.3 million TEUs and 54.5 million short tons in 2025 across their public terminals.
Exactly. Constant growth.
But wait, hold on, because this is where I am getting hung up. The report spends a lot of ink on something called Project 11.
Ah, yeah.
Yeah.
Project 11, the massive infrastructure initiative to basically widen and deepen the channel.
Right, and it says it is about 70% complete right now, with full completion slated for 2029.
Mhm.
But if they are already breaking all-time records in 2024 and then breaking them again in 2025 with the channel exactly the way it is right now,
I see where you're going with this.
right, like why spend billions of dollars and years of political capital digging a wider ditch? If the current setup is already handling record numbers, are the boats really getting that much bigger, or are they just fixing a traffic jam?
Well, it comes down to the brutal math of global shipping.
Yeah,
Ocean carriers are constantly seeking economies of scale.
okay.
They are building wider, deeper drafting vessels because, frankly, moving 10,000 containers on one ship is exponentially cheaper than moving 5,000 containers on two ships.
That makes sense.
So Project 11 is really about future-proofing. If a port cannot safely and efficiently accommodate the next generation of those mega vessels, the shipping lines will simply route them to a port that can.
Oh, wow. They'll just bypass them entirely.
Exactly. By deepening and widening the channel, Houston is sending a signal to global supply chain managers. They're saying, we will be a reliable, highly efficient node not just for today's traffic, but for the vessels that will be sailing 20 years from now.
Okay, gotcha. So they are securing their place on the global map so they don't get left behind.
Right.
But to understand how this waterway expansion translates into actual business, We really have to look at how we measure the cargo going through it and how Houston stacks up against the rest of the country in early 2026.
Yeah, and the report makes a really crucial distinction here, one that is honestly vital for anyone trying to understand global shipping.
Okay, what is it?
You have to separate volume from weight.
Yes. The report explicitly warns us not to compare container volume and cargo tonnage directly. Let's break that down for you listening. When we talk about volume, we are talking about TEUs.
Right.
That stands for 20-foot equivalent unit. Imagine a standard metal shipping container that is 20 feet long, 8 feet wide, and 8.5 feet high. That is one TEU. It is simply a unit of space.
Exactly. And then you have cargo tonnage, which is measured in short tons,
Yeah.
meaning 2,000 pounds.
Okay.
So a TEU can be filled with pillows,
Right.
making it incredibly light. Or it'd be filled with cast iron machinery, making it incredibly heavy.
Right. Same volume, completely different weight.
Exactly. And the port tracks both metrics meticulously because they tell entirely different stories about the health and direction of the economy.
Okay, so let's look at the May 2026 snapshot. Port Houston handled 398,322 TEUs in that single month.
Which is a huge number.
It is. That is a 4% year-over-year increase and a 13% jump just from April. It brings their 2026 year-to-date total to nearly 1.9 million TEUs. The report frames this as a very positive thing. But let's look at the national comparison they included. 67% of large U.S. ports grew in May 2026.
Right. Everyone was growing.
Yeah, and the West Coast ports rebounded aggressively. Long Beach was up 32%. Los Angeles was up 17%. Meanwhile, on the East Coast, New York and New Jersey actually dropped 9%, and Seattle-Tacoma dropped 5%.
Yeah, a lot of varied numbers there.
Right. So back to Houston, they are at 4%. If Long Beach is up 32% and LA is up 17%, why is the report framing Houston's 4% as this massive strategic win for the Gulf Coast? It seems kind of low in comparison.
I get that. But you have to remember, volatility is the enemy of a supply chain.
Oh, interesting.
Yeah. Think about what a 32% year-over-year swing actually means on the ground. It means chaos.
Because it's so unpredictable.
Exactly. It means one year you have empty docks and laid-off workers, and the next year ships are idling offshore for weeks because there aren't enough truck chassis or rail cars to move a sudden, massive influx of boxes.
That sounds like a nightmare for logistics.
It is. After the intense boom and bust cycles we have seen in global shipping over the last few years, major logistics companies just crave predictability.
They want boring, steady growth.
Yes. Maintaining a stable 4% growth month after month, year after year, allows businesses to actually plan. It allows a developer to confidently buy land and pour concrete.
Right.
A 32% spike is often just a violent correction from a previous severe dip. Houston's 4% is structural, reliable growth.
Which brings us to the land. If we have a reliable, steady stream of metal boxes arriving at the docks every single month, they can't just stack up on the water forever.
No, eventually they have to hit land.
And that physical reality is crashing into the Southeast Houston warehouse market right now.
Yeah, and the numbers in the Southeast submarket for Q2 2026 are staggering. The total inventory of industrial space there is 86.3 million square feet.
Just try to picture 86 million square feet of concrete. That's insane.
It's massive.
But here's the hook we teased at the very beginning of the deep dive. The direct vacancy rate in that specific submarket rose to 11.3%. And the weighted triple net asking rents are sitting at 73 cents per square foot.
Right.
Quick time out, though, before we go further. What does triple net actually mean in this context?
Good question. A triple net lease, which is often written as NNN, means the tenant agrees to pay all real estate taxes, building insurance, and maintenance on the property.
Okay, so on top of the rent.
Exactly, in addition to any normal fees that are expected, like base rent and utilities. So that 73 cents is a monthly figure, meaning a tenant is paying 73 cents per square foot per month in base rent, and then covering all those building operating costs on top of that.
Got it. Okay, so let's look at the numbers game of supply and demand here. The net absorption for the current quarter, meaning the amount of space that actually got leased and occupied by a tenant, was 633,308 square feet.
Right.
That seems like a healthy number, but the current quarter deliveries, the brand new warehouses actually finishing construction and opening their doors, was over 2.24 million square feet.
Yeah, quite a gap there.
A huge gap. Plus, there is still another 3.17 million square feet in the construction pipeline. To give you some citywide context, Houston overall has 376.8 million square feet of industrial space, with a much lower 6.4% vacancy rate.
Hmm.
So this 11.3% vacancy in the southeast is highly localized right near the port. Honestly, it feels like a beach town building 10 huge hotels right before the summer season starts. They delivered 2.2 million square feet, but the market only absorbed about 630,000. It looks, on paper, like they totally overbuilt.
It does look like that, but this brings up how industrial real estate actually works near major logistics hubs. Developers are executing a strategy based on speculative space.
Speculative
Yeah,
space.
they pour the concrete, they raise the tilt wall panels, and put on the roof without a single signed lease.
Wow, that seems really risky. Why take that gamble?
Because tenant demand is fundamentally strong for modern logistics and cross-dock facilities in this specific corridor.
Okay, wait. Another term we should probably clarify. Cross-dock facility. What is that?
Ah, sure. Think of a standard warehouse as a massive storage closet. Goods go in, they sit on a rack for months, and eventually they leave.
Okay.
A cross-dock facility is more like a sorting machine. It is a long rectangular building with truck doors on both sides.
Oh, I've seen those.
Right. So an inbound truck from the port backs up to one side and unloads cargo. That cargo is immediately sorted and loaded directly onto outbound trucks on the exact opposite side of the building. The goods might only be in the building for a few hours.
Gotcha. So it's speed over storage.
Speed is the entire game. A major retailer shifting its supply chain just cannot wait 18 months for a facility to be permitted and built. They need space tomorrow.
Right.
So developers are front-loading the supply to capture that immediate demand. The 11.3% vacancy is just a temporary mechanical symptom of brand new deliveries hitting the market all at once, not a symptom of failing demand.
Okay, that clears that up. But to see if that gamble actually pays off, to see if those empty cross docks actually fill up with trucks, we have to know what is inside these boxes.
Yes, the contents matter.
We have to look at the global chessboard here, because the mix of goods coming in and out dictates exactly what kind of real estate is needed.
And the trade profile of Port Houston is highly distinct. On the import side, China remains the dominant partner by container volume. They handle about a third of all inbound cargo.
Okay.
But Mexico leads by cargo weight.
Oh, which perfectly illustrates our volume versus weight discussion from earlier. China is sending boxes full of high-volume, potentially lighter consumer goods like the pillows, while Mexico is sending incredibly heavy industrial components across the Gulf.
Exactly. And the report also highlights a fascinating shift in the landscape. Vietnam is the only major trading partner to record sustained growth in import tonnage since 2024.
Really? Vietnam?
Yeah. As for what is coming in overall, machinery and consumer goods are the top imports. But the May 2026 data specifically noted a 79% jump in dry bulk imports, while general imports dropped 63%.
A 79% jump in dry bulk. What exactly constitutes dry bulk?
So dry bulk is cargo that is unpackaged and poured directly into the hold of a ship.
Like dirt.
Yeah, think of grain, coal, gravel, or raw plastic pellets. It isn't loaded into a neatly stacked shipping container. It is literally scooped or poured. So a 79% jump indicates a massive surge in raw materials feeding the local industrial base.
Okay. And what about the other side of the equation? What are we sending back out?
Well, while imports are fairly concentrated with partners like China, Mexico, and Vietnam, Houston's exports are really broadly distributed across the globe.
Yeah.
With Europe and Far Asia as the top destinations.
Okay.
And the export volumes are completely dominated by resins and plastics.
Okay, so let's connect these pieces. We bring in heavy machinery and consumer goods from Asia and Mexico.
Right.
We see a massive surge in raw, unpackaged dry bulk. And we ship out vast volumes of resins and plastics to Europe and the Far East. So Houston isn't just a transit point where boxes are shuffled around.
Not at all.
It is acting as an industrial conversion engine. It sucks in heavy machinery to build and maintain the petrochemical plants. Those plants take Texas oil and gas, convert it into plastic pellets, which are basically the chemical building blocks of modern life, and then the port pumps those pellets back out to the rest of the world.
That's spot on. The port is the physical manifestation of the region's industrial ecosystem. The imports feed the machine, and the exports are the product of that machine.
That's so cool. But I want to circle back to Vietnam really quickly. Why are they the only trading partner showing sustained import tonnage growth since 2024?
It really comes down to supply chain diversification. Companies learned very, very hard lessons over the last few years about the dangers of over-reliance on a single country for manufacturing.
Ah, yeah, that makes sense.
So we are seeing a structural shift where supply chains are physically moving, hedging their bets by relocating production into Southeast Asia.
Yep.
Houston's ability to handle these shifting trade routes, like absorbing the rise of Vietnam while still managing vast flows from China and Mexico, it really proves its resilience. It shows the port can adapt to wherever the global economy decides to manufacture its goods.
But there is a missing financial piece here. With all these diverse goods pouring in from Vietnam, China, and Mexico, eventually landing in those 86 million square feet of warehouses in Southeast Houston, how do these companies handle the upfront tax burden? I mean, if a company imports $50 million worth of electronics, they usually owe the U.S. government a hefty tariff the absolute second the cargo crosses the border, right?
Usually, yes.
So how do companies afford to just sit on that inventory in those empty speculative warehouses while they wait for retail orders?
That is the multi-billion-dollar question. And the answer lies in a very specific geographic legal loophole detailed in the report. It's called Foreign Trade Zone 84.
Foreign trade zone. Tell us how this works in practice.
So a foreign trade zone is a designated area that U.S. Customs and Border Protection treats as being physically outside U.S. Customs territory for tariff and duty purposes.
Wait, really?
Yeah, and FTZ 84 encompasses Port Houston and many of the surrounding industrial parks.
So the warehouse is physically sitting in Southeast Houston, in Texas, in the United States.
Yep.
But legally,
Legally and financially, as far as customs duties are concerned, the cargo has not crossed the border yet.
that's crazy. It is like an embassy for cargo. You know how an embassy is considered the soil of its home country, even though it is sitting right in the middle of a foreign capital?
Exactly.
These warehouses are like embassies for global trade.
That's a great way to put it. And the financial cash flow benefits of this mechanism are immense. No duties are paid until the goods physically leave the zone and enter U.S. commerce.
Oh, wow.
Consider a company that imports electronic components from Vietnam. They bring them into a warehouse inside FTZ 84. They can store them, assemble them into a finished product, or repackage them, all without paying a single dime in tariffs.
That's incredible.
And if they eventually sell that product into the U.S. market, they pay the duty then. But if they re-export that finished product to, say, South America, they pay absolutely no U.S. duties at all.
So they defer the tax until the moment they actually make a sale, which frees up untold amounts of cash flow.
Yes. The scale of FTZ 84 is staggering. It is managed by the #1 U.S. port. It supports 201 individual businesses, sustains 13,000 jobs, and handles exports valued at $10 billion.
Unbelievable.
It is basically the financial lubricant that makes the physical real estate viable.
Right. Without the FTZ, the physical real estate, those 2.2 million square feet of new speculative warehouses, and the physical infrastructure of Project 11 wouldn't make any economic sense.
Exactly.
The carrying costs of the inventory would just crush the importers. The physical concrete and the legal tax structures are completely interdependent.
You literally cannot have the warehouse boom without the FTZ sheltering the cargo inside it.
Okay, let's tie this all together for you listening. We started with a 52-mile waterway. And because that channel is being physically widened and deepened to accommodate the next generation of megaships, developers are confidently pouring millions of square feet of concrete on land to build cross-dock warehouses.
Yep.
Those empty buildings aren't a sign of failure. They are a calculated landing pad for a global supply chain that is rapidly diversifying, pulling in massive cargo weights from Mexico and surging volumes from Vietnam.
Spot on.
And all of this is only affordable because of the invisible legal boundary of a foreign trade zone. It is amazing how a shift in a trade route in Southeast Asia literally dictates the pouring of concrete in Texas.
It really is all connected.
Before we wrap up, what is something in this data that points to the future? What should we be watching?
Well, there was a really provocative thought buried in the data regarding imports. The report notes that Mexico already leads Houston's imports by weight. And that is entirely due to cross-border manufacturing.
Sure.
So as the trend of nearshoring accelerates, meaning companies moving their factories out of Asia and placing them in Mexico to shorten the distance to U.S. consumers, how will that physically shift the real estate market?
Oh, because if the goods are being manufactured in Monterey instead of Shanghai, they aren't crossing the Pacific Ocean on a boat.
Exactly. Will these immense ocean-facing container terminals eventually have to compete for warehouse space with a continuous, relentless fleet of trucks driving straight up the highway from the southern border?
Wow.
The infrastructure of Southeast Houston was built to face the water, but the future of heavy manufacturing might literally be arriving on 18 wheels from the south.
That is a fascinating shift to ponder. So The next time you drive past one of those sprawling, featureless industrial parks outside a major city, remember you aren't just looking at concrete and metal. You're looking at the very end of a global supply artery, an embassy for cargo, and a highly calculated bet on the future of world trade.